Stocks swing between red and green after a strong opening ahead of a holiday. Utilities and financials lead gains while IT and healthcare drag.
SBI and Bank of Baroda post record high returns on assets riding on a strong credit cycle. Even Indian Overseas Bank or IOB sees strong growth in credit lending to gain in market share.
Britannia posts strong revenues and a record market share but tightened guides for slimmer margins, while Marico reports tighter margins and a weaker growth outlook.
NIIT jumps on a $65 million acquisition. Higher revenues charge up Power Grid, while weak margins and a 4 to 5 quarter to recovery guidance impacts Escorts Kubota. Hello and welcome to Halftime Report. I'm Ekta Batra and with me Sonal Bhutra as well as Mangalam Malu. Well, it's turning out to be a session where we are pretty much making up our mind in terms of what we want to do. As of now, the mid-cap index is managing to outperform, so up around 0.5% currently for the mid-cap index. Yes, we have a lot of commitment from the FIIs in the past couple of trading sessions, so that's definitely a thumbs up for us. But for today, the resilience is definitely from the banking space as well. Look at the Bank Nifty charged up with a gain of around 0.4%, courtesy the likes of State Bank of India as well as Bank of Baroda, which really outperformed in terms of numbers. As you can see, both the stocks gaining and at fresh highs or fresh 52-week highs. We have a lot more to talk about, divergent trends within the entire FMCG space. Britannia, Marico, for example, stand out, and a lot of numbers to expect as well. Divi's Labs, case in point, would be one number that I'm working with. BPCL, Coal India, not to mention that tomorrow, interestingly, we have Dr. Lal's as well as Metropolis coming out. So it'll be really a comparison in terms of what the diagnostics report.
It indeed will be. And I'm looking at a bunch of stocks, which are buzzing around. You did speak about Britannia, but just take a look at a lot of these cash stocks which are surging. NIIT made an acquisition. The stock is up 11 odd %. A lot of these rail-focused stocks are doing extremely well as well. RVNL, for instance, is up almost, 11.5 odd %. We've seen a big move in RailTel as well, which is up 6.5 odd %. So the broader market's telling you that, irrespective of the resistance that we're facing in the frontline index, the broader market or the health of the market itself is pretty good, and that's what we're witnessing. But we do have a management.
We do, and I can't say the same about specialty chemicals as well, right? So we are going to be talking to a management as well, but a lot of these stocks, be it SRF, Neogen Chemicals, Satwa Chintan, all of them are down in trade today, and this is a result of their earnings. Rossari Bio is the other one. So, of course, we'll be discussing them in greater detail today, but let's start with the first management. AMI Organics posted a decent set of Q2 FY23 numbers. Company witnessed decent revenue and profits growth. However, margins were under some pressure. To discuss this, Naresh Patel, the Executive Chairman and Managing Director of the company, is joining us now. Mr. Patel, good afternoon. Thanks a lot for joining us. Always a pleasure speaking with you. Well, this time around, top-line growth largely driven by your advanced intermediate segment, which saw 25% growth, but chemicals was flat on a YY basis. What led to this? Why was chemicals flat? Why was there no growth this time around? And this growth that you've seen in the top line overall, how much of it was driven by volumes and how much by realizations?
Thank you. Thank you very much. Good afternoon, everyone, and thanks for allowing us to represent ourselves in your channel. You rightly says that our advanced intermediate and pharma business is growing at a very good space, whereas the specialty flattish kind of things. But you should also understand that the specialty chemical segments, just 1 year back, we had acquired from Gujarat Organics, and we are strengthening this business with implementing several aspects in terms of operational efficiency, new technology inclusions, as well as maintaining the product quality at a higher stand. So these are all three cumulative areas where we are working, and by this way, quarter to quarter, we are trying to improve in our positioning in the market, because specialty chemical volume is very high, and we want to go at a full force with all input of flow chemistry as well as other operational efficiency. So in terms of volume growth, normally every year we are our demand of old molecules are growing at 8 to 10%, whereas the new molecules are coming every year around 8 to 9 products, which are bringing the volume of around 40-45% of in the growth rate. So that is how mostly is a volume growth, not the value growth.
Right. Mr. Patel, just wanted to understand, the impact of currency fluctuation in your second quarter, because as I see, almost 60% of your revenue is coming from exports. And if you could confirm, how much of that comes in from Italy, Finland, France, and China, roughly 3 quarters, I guess. What was the impact of currency on your numbers this time around?
See, currently fluctuation is not impacting on us because we are natural hedging our imports against the export as well as our euro is also we are every quarter we are protecting ourselves. So the revenue loss in terms of foreign exchange is only 64 lakhs in 147 crore turnover of the quarter.
Okay. Mr. Patel, have you benefited at all from a +1 factor? The reason I ask is that you do have, a strong number of products in your advanced intermediate space, which is basically focused towards the chronic drugs. Is there any kind of, benefit from companies moving away from China? Any +1 that you've benefited from and that you can guide us towards as well?
Yeah, normally whatever the product we are doing, we are normally dominating in the world, and around 80% of the market of that API is controlled by AMI Organics. So in that sense, we have normally China is our second vendor, whereas we are the normally on the number one vendor in the worldwide. So in that sense, we are always dominating in our segments of all the intermediates of that API. But
And
nowadays,
that's
because of this European crisis and all, now they are whatever the intermediate we are supplying now, we are having a more requirement from forward integrations rather than the intermediates which we are selling. So it is also new possibility open up for us in because of this European crisis and all.
Okay, so.
Okay, but can you quantify it for us? Can you quantify what's happening for us right now? Are you already receiving queries from clients who are looking to move out, say from China? Are you looking at that advantage coming through from Europe already? Give us some qualitative information.
Yeah, so China Plus theory is already implemented, and we are already in a pole position in that area where because so many intermediates which are qualified with worldwide globally, and whatever the quantum was going to China, that is shifting to us. Not only that, several European API manufacturer they can't immediately transfer API to India, but they can ask us for the advanced intermediate which we are supplying starting material. So they are started asking for advanced intermediate. So this is how new opportunities coming to AMI Organics in that sense.
Okay, so you're talking about newer opportunities when it comes to Europe +1 or China +1 theme, but you do have some expansions in place already. You spoke about your electrolyte additive products, which where you're starting the trial order. Has it already started? Because you've given November as the timeline. Is it happening mid-November, last week of November? What kind of initial order are you expecting here? Will it increase or improve your margin profile? And what is just a ballpark figure in terms of the initial revenues that this particular product could bring in for you just in this year?
See, basically, energy device business is a very long procedure of qualification. First, you have to approve in the quality. Then they place an order for the trial batches, and that is somewhere around multi-tons of small multi-tons of orders. And from that, they make their devices and then run for the safety checks and all. So this is the stage where we enter now. And in this month, we might be getting several tons of order for these electrolyte additives. So after these supplies, then it will be go on a commercial scale, and it is a very huge demand worldwide for these electrolyte additives. And we enter in that phase in FY24. Yeah. In terms of margin point of view, the margin will be much better than the specialty chemical segments, and because of the quantum is very high, you cannot expect a very huge margin, but it will be remain in the same line of a pharma,
right.
Bit on a better side.
We take that point. So finally, before we let you go, I mean, to sum things up, the first half of this year, you've done around 18% in terms of revenue growth, with about 18.5% in terms of margins. Do you think that will replicate in the second half of this year as well, or will you grow faster? What's your overall target for the year?
Yeah, so Q1 was 18, Q2 was 19, and we have already announced that every quarter we will be improving 1 or 2% basis in our margin, and that will be also reflecting our result, and it will be continuously improvement in upcoming quarters as well.
All right.
Okay, all right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's AMI Organics. That is only the first company on our show. We have a packed lineup for you in the next 30 or 40 minutes. So we're going to take a short break, but on the other side, stay tuned. We'll be focusing on the big buzzing space today, PSU banks, as well as from the FMCG space, Britannia. Don't go anywhere.
Welcome back. Well, a segment that is doing really well today is the PSU banking space. Most of the stocks are buzzing in trade today, and it's been operationally strong quarter for these banks as well. Abhishek is here to tell us more. Abhishek?
Well, Q2 FY23 has been an operationally strong quarter for the PSU banks. The loan growth has been pretty robust at above 19% YOY and about close to 5% sequentially, which means that they have gained market share both YOY and quarter on quarter. So the operating profit growth is very healthy at 18% YOY and about 32.1% sequentially, largely led by the fact, net interest margin has expanded for majority of these PSU banks on a sequential basis, and the trading losses that they had in Q1 has actually reversed for many of them. So PAT is up about 50.4% YOY and about 65.7% sequentially. While the operating profits are healthy, the declining credit costs have actually helped the earnings momentum for PSU banks. So the return on advances that I've calculated is at about 1.35%, up from 0.85% in the previous quarter and up from 1.07% in the same quarter last year. In absolute value, their gross NPA is down 15.9% YOY and about 13% sequentially, and their net NPA is down about 29.3% YOY and 13% sequentially. So calculation does show that the gross NPA ratio is now at 6.5% when compared to 7.5% in the previous quarter, and the net NPA ratio is at 1.65% when compared to around 2% in the previous quarter. So overall, the core provision coverage ratio has also strengthened by 120 basis points on a sequential basis. Back to you.
Okay, well, no complaining really, Abhishek, about the entire PSU banking space. In fact, let's listen to the biggest bank of them all, State Bank of India, on their Q2 performance.
We have got visibility of either proposals in pipeline or one which are sanctioned already, awaiting disbursement. So all that is somewhere in the range of about 3.5 trillion plus as far as the corporates are concerned. So I expect that going forward, the kind of availment which has happened from corporates in this quarter will have the visibility of similar availment going forward, because corporates are earlier raising money from overseas markets. Now overseas markets have turned expensive, and with the hedging cost, perhaps it is much cheaper to borrow from India as compared to borrowing overseas. And infrastructure continues to be a major focus area, and apart from that, the renewable energy is another very major area, and the PLI has also started showing good demand.
All right, so that's about the banks. Let's move on to the biscuits from the banks now. And Britannia, that's the stock of the day today, up almost 10%. In fact, at a fresh record high. As we speak, the company has also crossed 1 lakh crore in terms of market cap. Why is that? Well, because in the second quarter, their revenues have been the highest ever as far as the quarter's numbers are concerned. Gross margins have improved, and the market share for the company too has been at a 15-year high. As far as the numbers are concerned, on all parameters, they've beat street estimates comprehensively. They've met the street estimates on volume growth of 4 to 5% as well. The only concern that the street had was that long-term debt for the company had risen by almost 1,000 odd crores, and to that the management has clarified in the conference call. They said that they've taken this debt only to fund capex because the cost of debt at 5.8% was extremely attractive, in fact much lower than the yield that their own treasury would bring as well. In fact, they clarified on a lot of the other doubts that the street had on group company issues. Bombay Dyeing, as they said, exercised the right to appeal against the SEBI order. On raw material prices, they said that they expect this to stabilize going forward. So it's good for the margins of the company going forward. New products, which now contribute about 5% to their revenues, have been growing extremely fast. So that's a positive. In fact, they gave us an example of their croissants business may end this year by almost 150 crores in terms of a run rate. And finally, in terms of the management transition, they've said that Rajneet Kohli, who was appointed as the ED and CEO very recently, will take full charge of day-to-day ops, with Varun Berry taking only strategic calls as well. So as a result of which, the stock's doing extremely well. What's also doing well is Bombay Burma, which holds about 50.5% stake in the company, worth almost 50,000 crores, and its own market cap is around 6,500 crores. So maybe it's the street giving a little more premium to the discount that it's trading with in terms of holding company. That's about Britannia. Let's actually listen into what Varun Berry, the MD of the company, had to say during the conference call.
While I'm not on the board of Bombay Dyeing, but whatever we know is that Bombay Dyeing has already clarified through their press release, that it's fully compliant and will exercise its right to appeal against the SEBI order. We've taken debt, yes. We've taken debt for our Ranjangaon expansion, which was a lot of that in dairy. The dairy plant is almost ready and should be commercialized soon. So dairy, then we've got a factory coming up in Tamil Nadu, a factory coming up in UP. To fund that, and we've got a loan at a very low price. We've got a loan at 5.8%. So we are looking at approximately exit rate of about 150 crores, which is, I would say, a reasonable number for a product which has just been launched. The total NPD contribution, it will probably be about 5%.
All right, that's the word coming in from Britannia, but it's time for a break. On the other side, we'll connect with Sapnesh Lalla of NIIT on their new acquisition. Remember, the stock is buzzing in trade, up 12%.
Welcome back. Let's talk about NIIT Limited. The stock is up almost 12% on the back of acquiring a US-based company, Charles Consulting, for about $65 million. It's a company that provides consulting, design, implementation solutions for strategic learning programs to professional service firms. So to discuss this acquisition and a lot more, we have Sapnesh Lalla, who is the CEO and Executive Director at the company, joining in. Thanks a lot, Sapnesh, for joining in. Congratulations on this deal. The street likes it. Just wanted to understand what proportion of revenues will come in this year, and what's the outlook for additional revenue in the next year itself? Because, I mean, I'm looking at your numbers. You do about 160 odd crores in this business, $20 million that is. What is the growth rate expected from this business for you?
Let me clarify a couple of things. First, the fixed price paid for this acquisition was about $23.4 million to acquire 100% of the equity. There is an earnout that is available to the management team as well as the founders, which will be based on their annual performance. The maximum earnout is going to be approximately $41 million. So overall, the fixed value of the deal is approximately $23.4 million. Their calendar year 21 revenues were approximately $21 million. They have grown reasonably well this year and have created an EBITDA profit of over 20% in the year 2021. We expect that EBITDA to grow both in overall terms as well as EBITDA profitability, or the profit margin is likely to grow in calendar year 22 as well as going forward.
Okay. Can you just give us a sense in terms of, you did speak about the EBITDA briefly, but what are the working margins for this particular business? When will it be integrated by, and what will the blended margins look like? The reason I ask is that in any case, NIIT has been reporting weaker margins. It was, for example, 14% in the quarter gone by. So what does this particular acquisition bring to the table in terms of margins, and what would it be on a blended basis?
Thanks. So this acquisition will become part of NIIT's corporate learning group business. The corporate learning group business has had margins in the 20+% range and has grown over the last few years at upwards of 20% year on year. The long-term view of the corporate learning group is a 20% growth, 20% margin business. This business is going to be in line with the corporate learning group business metrics. So it will be accretive from a margin perspective as well as EPS perspective. With the integration of St. Charles will become from day one. It will get fully integrated into NIIT's numbers as well as the corporate learning group's numbers. And like I pointed out, they're likely to grow at a pace that is greater than 20% year on year, and their margin is likely to be north of 20% yearly.
Okay, so for the acquisition, a growth of 20% on the top line and 20% margins is what is expected. Mr. Lalla, I wanted to understand about client integration as well. What does it do to your client profile since it is in the corporate learning group segment? Will it bring newer clients? If yes, by how much? Or will it be repeat clients for you?
So this is a very good question. Most of St. Charles Consulting Group's customers are the top management and strategy consulting companies. 12 of the top 15 strategy and management consulting companies are their customers. These companies are known to spend more than 2.5 times of what an average company spends on their L&D. So a very lucrative set of customers. This is a segment where NIIT had not penetrated fully in the past. And so most of their customers will be first-time customers for NIIT. And those customers will have an opportunity to get a stronger and a wider range of services, including the services that they get today from St. Charles. So there is an opportunity to expand the share of wallet for St. Charles customers by including NIIT services.
Right. And final question, Mr. Lalla, just wanted to understand the growth prognosis for this acquired business. I mean, between 2019 and 2021, the company grew at roughly 15 to 17% CAGR over 2 years. But this was also because of, at a time when we were suffering from the COVID pandemic. So going forward, what is the sustainable growth trajectory of this business post-COVID and the synergies that you will realize? Because 20% is the margin that the company does already. You expect it to grow further. Could you give us a sense how much it would be and what would the synergies be?
Sure. That's a great question. Like I mentioned, their customers are the large strategy and consulting management consulting companies. Those companies, as I mentioned, spend a lot on training. And as you know, the world is going through a number of different vectors of transformation. The talent is at the top of every CEO's agenda, and the top management and strategy consulting companies are helping many CEOs deal with the talent transformation problems that most CEOs are facing. By St. Charles being sort of a consultant to the consultant, specifically on talent and talent transformation related issues, it gives NIIT a great position to participate in the future of work and consult with organizations who are at the forefront. Obviously, this will be synergistic. Both, as I mentioned to you, a number of St. Charles customers could access a larger framework of services from NIIT, but the strategy and consulting services that St. Charles offers to its customers could also be offered to NIIT's over 70 customers from a managed training services perspective. And consulting has been a growing line of business for NIIT. And by bringing St. Charles's capabilities, we will be able to service our customers much better than we have been in the past. And NIIT will become the most preferred partner for our customers going forward with an expanded set of capabilities.
All right, Mr. Lalla, it was a pleasure speaking with you. Thank you so much for joining us and explaining the rationale of this new acquisition that you've made and the synergy benefits as well that you're expecting. With that, we'll slip into a short break now. We'll next put focus on Rossari Biotech and speak to the co-founder and managing director, Sunil Chari.
Welcome back. Well, stable for the markets, mixed you'd have to say. So the mid-caps as well as the financials are managing to hold their head above the water with gains of around 0.5%. But let's get talking about a couple of other companies. Rossari Biotech is the other company that we're looking at today. It posted what was a weak set of Q2 FY23 numbers, with profit after tax seeing a 17% decline and operating profit margin was flat on a Q-on-Q basis. Sunil Chari, who's the co-founder and managing director at Rossari Biotech, joins in now to discuss the numbers. Mr. Chari, hi, welcome to the show. Well, your numbers on a year-on-year basis are not comparable, But I just wanted to get a sense in terms of the raw material environment for you this quarter as compared to the previous quarter. Because despite your revenue declining maybe marginally by around 2%, you've managed to maintain your margins at 13%. So tell us what the environment is like and what are you guiding for based on your visibility currently?
I think we had an excellent half year. If you compare our half year last year, we were at 615 crores, and today we are at 860 crores in the first half of the year. If you see our half yearly EBITDA at 114 crores, we are nearly the same as the entire year last year of about 120 crores of EBITDA. So we are pleased. The markets, macroeconomic conditions outlook is not so good, but we've been able to increase our margins, EBITDA margins. 114 crores is something which is in line with what we had guided to everyone. Our HPPC, the main segment which drives Rossari, we are at 72% HPPC compared to 60%. If you see the first half of the last year, we were 366 crores HPPC, and today we are at 620 crores. So as a company, we are very happy. The raw material conditions are stable now, but the supply chain also is stable. But we continue to see volatility based on macroeconomic conditions, especially the China-Taiwan war, the Ukraine-Russia war. They have impacted a little. Europe seems to be weaker. So we see certainly some effect on Tristar in this quarter because Europe offtake. We have orders, but customers are not picking up well. But the HPPC segment continues to be good. Textile is a little weaker. As we know, exports have been slower. But we have been able to maintain our sales in this segment also.
Okay. Mr. Chari, you spoke about textile specialty chemicals segment, which is impacted due to exports. In second quarter itself, we saw a decline both on a quarter-on-quarter and on a YOY basis. Are you seeing any uptick here in this particular segment? And last time you had told us that Romax backward integration in silicon will be able to, scale up your product portfolio in this particular segment. What is happening here? When can we expect that growth to come in?
See, if you see what we did in the last 1 year, we acquired 3 companies and we have done integration very well. Unitop is a leader in agro surfactants, Romac in silicones, and Tristar in personal care actives. All these acquisitions have done very well. We have integrated well. We had no surprises. Governance levels are fantastic for all the 3 companies. So what we see is silicone surfactants is going to be a good growth area for us in the future. This quarter, the last quarter, we launched for the first time trials of a silicone super spreader. And this could do well for us both in domestic market and in the export market. Silicone surfactants are used widely in agro, where we have a good strength because of Unitop. But silicone surfactants are also used in performance chemicals, both in personal care, in home care. They are also used in paints, inks, and other industries. We would like to grow this to a substantial levels. Synergy in development is seen very clearly in this quarter between the 3 companies. Besides, being very strong on product portfolio and manufacturing capability, we got a good set of team of skilled manpower in all these companies. And we launched 3 products, phenoxypropanol, which was again a synergy work between 3 R&D teams where we made the product in Unitop partly. We made it, finished it in Tristar and sold it through Rossari to Rossari's customers. Similarly, silicone spreader is something which will do very well for us in the future.
So when you are very optimistic about all these products that you've launched and the fact that the backward integration in silicon will start giving you results in quarters to come, can you quantify it for us? Because that is something that the street will be looking for because of the decline that we have seen on a quarter-on-quarter basis. What is the absolute revenue amount that you're looking at, or a ballpark? What is the opportunity here?
See, 860 crores in the first half is something which is as per guidance, and we see a similar amount or better. We are not able to understand the macroeconomic or the geopolitical outlook, especially China and Taiwan and Russia and Ukraine, and the effect on Europe, especially with the energy situation. And as this quarter ends, we will be in a better position to tell you. but we are confident of, doing the same or better than the first half.
Right, because it's interesting because the last time you joined us, you did say that you're looking at 2,000 crores for the entire year with 250 crores of EBITDA. Now that you're saying that, you will do at least this much in the next year, what you've done in the first half, 850 crores, assuming that you do 900 there, you would have effectively scaled your revenue guidance down by about 200 odd crores. Be that as it may, will you be confident of meeting your EBITDA guidance of 250 crores? Because out here, first half you've done around 115 crores. And what's wrong with the margins? I mean, you are taking a lot of steps in improving them, etc. But at peak, they were 18%. Then FY22, of course, they fell down to around 11%. This year, so far, it's still at around that 13.5% itself.
So if you see the guidance for this year, we were at EBITDA guidance percentage of 12.5%. For the first half, we are at, above 13%. So we are better in terms of EBITDA guidance. And we want to be conservative in our guidance rather than be, very optimistic, because we are not sure of what the geopolitical situations will take. At this moment, our internal budgets still stand at 2,000 crores, but it will depend on the macroeconomic conditions.
Okay. All right, Mr. Chari, it was a pleasure speaking with you. Thank you so much for joining us and giving us all those details. So macro uncertainty is still impacting margins for the company, and that is something that we'll be watching out for.
Just before we take a break, I just want to pull up Divi's Labs because that is coming out with its numbers soon enough. And the stock, in fact, has moved to the low point of the day. The stock is now down around 1.7% at the low point. Remember that they have their earnings call, which is slated for 2 p.m. this afternoon. So the numbers should be out any time now, probably maybe in the next 1 hour odd, considering that they do have that analyst call starting at 2 p.m. in the afternoon. Important set of numbers to watch out for. The street will be watching out for what the impact of Molnupiravir API would be in terms of the total business. Just watch out for Divi's Labs at the low point of the day ahead of its numbers. Take a break, but on the other side, we'll focus on Marico as well as Tattva Chintan Pharma, both these stocks reacting to numbers. Stay tuned.
Welcome back. The Nifty is meandering around that 18,100 mark, and that brings us to the time when we look at what's taking place in the F&O space. Well, the last couple of trading sessions, we were looking at the 18,000 straddle being extremely active. That has now moved to 18,200. That is the call which has added almost 65 lakh shares for a premium of 70 odd rupees. And on the put side as well, it's 18,200 put, which is extremely active. Added close to around 23-24 lakh shares. The premium is around 130 odd rupees out there. Bring both of them together for a premium of 200 rupees. The street is playing for a range between 18,000 to 18,400. And that is a marked shift from the earlier range that they were playing at, which was 17,800 to 18,300. So what this basically means is that the bulls believe that 18,000 will now be a firm support in the near term, as again 17,750 to 17,800 that we're looking at. And that's primarily because of the resilience that we've seen in our markets and the fact that we've continue to gain from strength to strength. So the support has moved higher from 17,800 to 18,000.
Okay, understandably, right? So that is about the F&O space. Let's get stock specific now, because a lot of stocks that are reacting to earnings over the weekend. I'm watching out for Tattva Chintan Pharma because it was a definite weak set for the company, and it's second consecutive quarter where the company has not done well. So a revenue decline of 27%, gross margins declined by 400 basis points on a YY basis, EBITDA down 69%, and margins, look at them, more than half this time around at 12.4% versus 29%. Profits also down 78% on a YY basis. It was majorly led by their SDA segment, which is majority of their revenues. Their company saw an 87% decline in revenues. The other ones, PTC and PASC, did really well for the company, up 50 to 60% this time. Company said that they expect improvement in their SDA sales from Q4 of FY23. So that is some positive commentary coming in there. FY23 sales should be around 400 crore rupees for the company. But be that as it may, SDA has not been performing well for the company, and that remains the pain point. ICICI Securities, on the back of this week's set, has cut their estimates on EPS by 37% for FY23. But since the company says that Q4 will be good, they've increased FY24 EPS estimates by 4.5%. The stock not at all cheap, 40 times 1 year forward earnings, and that has fallen from levels of 60 times that it used to trade at. Still not very promising for the investors, and the stock is declining in trade today.
Okay, so quite a steep reaction on the downside there. But the other one is definitely Marico. It's the biggest F&O loser today. Manglam, tell us more. What went wrong for the company?
Well, the fact that there was no outperformance is the biggest thing that, the street did not like, because so far all the FMCG companies that have reported their numbers, we've seen some beat to what the street was working with this time around. So Marico's reported absolutely in line set of numbers. I mean, revenues bang in line. We had the EBITDA at 433 crores. The street was working with a number of 435 odd crores, and the net profit has been slightly below expectations. But that again was expected primarily because the effective tax rate of the company has increased. Domestic volume growth is at 3% versus expectations of about 1 to 2 odd percent. The gross margins, while they've improved, year on year, we've seen some decline sequentially. So important is to know whether they will improve going forward or not. And to that extent, the management has said that gross margins will improve sequentially from the third quarter, and they are targeting, now that the volumes have gone into the positive terrain this time around, they are targeting mid-single digit volume growth in the second half of this year in the domestic business, while they maintain their aspiration to deliver 18 to 19% margin in this year. The first half itself, they've done close to around that 17.5% mark. So expecting them to improve going forward. But I think the street will only like, the company to go ahead and report those numbers as against promise those numbers, because so far the street has not given it 2 thumbs up despite it being in line.
That's on Marico. In fact, we'll get more details on the Q2 performance from the management in a short while from now. Saugata Gupta, MD and CEO Marico, will be joining us at 1:30 p.m. So stay tuned.
That we'll on the other side, we will talk all things commodities with Manisha Gupta. She joins in with Nivedan Churiwal, who's the managing director at BSL. Stay tuned.
Welcome back. Well, there are a couple of other big interesting numbers to expect in today's trading session. So there will be 197 Communications, which is basically Paytm, which will be releasing its numbers today. Their conference call is going to be held tomorrow evening at around 6 p.m. So maybe let's see what they have to say. But as of now, the company is expected to report a net loss as per our poll of around 596 odd crores. So do watch out for Paytm. The stock is up around 0.8% at this point in time. But Manisha Gupta, our commodities editor, is now with us to tell us what she's tracking today. Manisha, over to you.
Thank you so much for that, Ekta. Well, I'm looking at the cotton prices, and when you look at the last week in the international markets, we saw the global cotton prices gain up by 19%, which has been, by the way, the best weekly gain in 12 years. And the gains in the commodity markets clearly came in after markets believe that China perhaps will, release or ease off the kind of restrictions that they have been putting on COVID. But that really did a U-turn and is the reason we have seen some profit-taking come back in this case of these prices. But let's talk about the global prices and the Indian markets as well. Nivedan Churiwal is MD at BSL, and he joins us on the show to do exactly that. Mr. Churiwal, hi, thank you so much for joining us. First of all, on the kind of volatile moves that we've seen in cotton prices internationally, in India as well, as industry, is it stabilizing now?
Well, as you rightly mentioned, the cotton prices have been extremely volatile for the past year. The candy prices started at around 40,000, and from there it went up to over ₹1 lakh, and today it is hovering in the range of between 60 to 65,000. It would still be risky to make a forecast or prediction as to where these prices would go from here. But it does look that with the new crop coming in, it should stabilize around this price, because stability is what is most important in order to secure more business, whether it is from the international markets or it is from local markets. And earlier we were all expecting that with the prices coming down, the demand would increase. But even with almost a 40% correction, the demand of yarn from the international markets has not gone up as we had expected. So I think we are all very hopeful with the new crop coming in. The prices should stabilize around the current prices, or maybe 5-10% plus or minus. Okay. And with that stability, the demand for yarn from the Western markets should start coming.
Mr. Churiwal, as you mentioned that the yarn exports really have been quite dismal. We do understand there's a 50% of a decline onto that one, and that is the reason perhaps there's a textile ministry meeting as well with the stakeholders, with some of the industry and association heads as well. How much of concern or how soon do you see the yarn exports or the yarn prices picking up?
See, up to first quarter of this year, the last 6-7 quarters were exceptionally good for the cotton spinning industry. There was unprecedented tailwinds, and everyone posted staggering unprecedented results. From the second quarter, things have totally turned upside down. Q3, we expect to be a little better, and from Q4, you would expect that situation should normalize. Now, you see, ultimately, the demand for cotton is going to be there. Presently, from the Western markets, due to the Ukraine-Russia situation, the energy crisis, and so on, the demand is very low, but it is a commodity and it is a cycle. Eventually, it will come back to its peak sooner than later, which we are all very hopeful.
Okay.
And if you look at the global perspective, the crops in Pakistan have failed, crops in USA have failed, the cotton crop is almost 50%, and we are all well aware of the China +1 policy. So there are no two ways about the fact that sooner or later, the demand for cotton from India will bounce back very strongly. And at whatever price the cotton raw material price is, the demand for yarn from India and garments, cotton-based products by and large, will surge back, hopefully sooner than later.
All right. Thank you so much for that, Mr. Churiwal, for joining us. So, well, as prices go, 5 to 7% of a move up and down, but the demand growth is something that they're definitely expecting to come back in case of the segment there.
Okay, thanks Manisha for that. Well, those are the Divi's numbers on your screen, and it's looking like a complete miss both on the top line as well as the bottom line. So it's coming at around 1,854 crores in terms of revenue. The street was anticipating around 2,200 odd crores this time round. So the street was anticipating around maybe a growth of 10 to 11 odd %. And remember, this compares to around 2,200 odd crores that they did in the previous quarter. So it is definitely lower on a sequential basis and lower versus our expectations as well. There's been a steep downtick in terms of the net profit as well. So 493 odd crores is what it's come in at. Remember, last quarter it was at around 659 odd crores and the street expectations were around 579 odd crores. We just want to wait by for the margins for Divi's, because remember that the key USP of Divi's Labs is basically the high margins that they managed to maintain. They have maintained over at least 40% in terms of margins in previous quarters, and it would definitely be a bit of a disappointment. So that, as you can see, the EBITDA is coming at around 621 crores. The street was anticipating over 800 odd crores in terms of a performance. Remember that there were multiple factors that the street was looking out for. Q1 FY23 was a big disappointment for Divi's in terms of numbers, as the margins had dipped over almost 600 basis points on a Q-on-Q basis, as the Molnupiravir opportunity had tapered. Plus, there was a slowing base business as well. So the street was anticipating that at least there would be a Q-on-Q recovery which would come through this quarter. Stability in numbers on a Q-on-Q basis is at least what the street was looking for. It seems as though they have not come through with those expectations, at least on a sequential basis. And that's the reason why you're seeing this steep disappointment which has come through for Divi's Labs. The stock down around 6 odd %. Remember, there was weakness in the custom synthesis business, which was basically one of the reasons was because of the reduction in supplies of the Molnupiravir API, which is basically the COVID-19 drug. But separately, the street was anticipating any kind of weakness in the base business X of Molnupiravir. And that's probably one of the reasons why we're seeing this kind of reaction, that maybe there is a disappointment which has come through in the base business for Divi's Labs as well. Net profit is at around 493 odd crores, and maybe we should pull up the margins and see what they've come in at on a calculated basis. Like I mentioned, the Divi's Labs margins have been generally even above 40 odd %. They have one of the best margins within the entire pharmaceutical space, and that's the reason why they're generally rewarded as much as they are. And if in case there is a sequential disappointment in the margins, then the street would probably be unhappy with it, because there was a stability in the Q-on-Q numbers that the street was anticipating. So EBITDA down around 24 odd %, coming at around 621 crores. So margins, as you can see, have come in at 33.5%. This compares to 38% in the previous quarter, or rather 37% in the previous quarter. So they've come in at 33%. The street was anticipating 38%. I think this is probably one of the lowest margins that Divi's has ever reported in its entire reporting history, or since I've been looking at the numbers at least. So it's definitely been a disappointment which has come in the margins. As you can see, 33% is what they have reported. It's a multi-quarter low when it's come in when it comes to the margins for Divi's Labs. Prakash Diwan is with us to tell us about his perspective on the numbers. Prakash, you know, there was this note on the 11th of October where an IIFL note had estimated that the revenue could decline over 20% on a Q-on-Q basis. And overall, there could be weakness in terms of the numbers. What is your sense in terms of what Divi's has reported?
So I'm sure, you know, even the poll of 2,200 odd crores that was expected from the company, that's been missed badly. So, you know, the poll had anticipated weakness, and this is much beyond that. So I think definitely this is a howler of sorts. Don't expect this from Divi's. And there was not any indication that it would be so dramatically low. So I think that 1,850 odd is definitely a big miss.
Okay, but margins, Prakash, you know, how would one look at the margins for Divi's? Because the premium has generally been given because of that 40% plus margins that they've reported, or maybe even 35% in a bad quarter. Now they've come in at 33.5%.
Absolutely. So, you know, I mean, that's exactly why even the profit miss of almost like 80 crores from what was expected at 570, 580 is a dramatic miss. So not only revenue, also margins at 33 odd is not something which I mean, these are very pedestrian numbers, right? I mean, you would not expect that from a company of this caliber. So we'll really have to figure out what's led to all this. This is very similar to what Lupin went through a few years back, where everything started crashing down in terms of revenue, in terms of margin, in terms of its pricing power. So there's something definitely that's beleaguered. I mean the stock is beleaguered with, and we'll have to figure that out. But it's a miss on all counts. Worrisome so on the margins as well, and then hence, you know, you could slice things like the EBITDA and everything, and why is it so down? But then I think intrinsically the margins itself is a big question, and there's something that we'll need to hear them out on to assess whether this is going to continue, or is it something we have to live with for more.
I remember last quarter the company had said that, you know, we could see quarterly variability in terms of margins, but the long-term margins will be in line with previous estimates. So let's see whether or not this is an actual aberration in terms of margins and whether they are intact on a long-term basis. But Prakash, you know, one thing about Divi's is that despite the correction, it still trades at a premium. If you look at it, you know, FY24 estimated EPS is around 100 odd rupees. It's still trading at over 30 odd times or thereabout. What is your sense? Do you think that there will be a shave off in terms of EPS estimates now?
Yes, so, you know, unfortunately, both the P multiple and the EPS could get contracted, is my sense. You know, when things go bad, and as you said, if the variability is on a quarterly basis, but it kind of evens out towards the mean reversion on the higher side, it would still be okay. But I don't think these numbers give you that comfort that it would happen in a hurry, which means that for at least the next 2-4 quarters, you know, the premium valuations would get shaved off, and so would the estimates on earnings, because you know, the market would love to reward earnings which will restore itself. The visibility needs to come back, which doesn't seem to be the same, because the company's been warning us, but you know, this is far more deeper than what probably we took it very lightly. The market took it very lightly.
This could more be about the base business declining and not just a molnupiravir opportunity diminishing, correct?
Yes. So that's why, you know, so that will exactly define how secular the thing would be in terms of this thing. If it's the base business itself contracting, then you know, it would take that much longer to come back and retrieve. And hence the valuations would definitely be deferred till then. The premium valuations would have to be deferred till then.
Okay, all right, Prakash, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So it's definitely a disappointment for Divi's Labs. Just to put it simply, the street was anticipating a revenue growth on a year-on-year basis, and they've come in with a decline. Not to mention that they have missed estimates on the profitability. As you can see, it's a decline in terms of profit versus what they reported same time last year. And the revenue is down around 7% on a year-on-year basis, with margins which have come in at a multi-quarter low. Remember, the conference call is at 2 p.m. this afternoon, so we'll get more details in terms of what the management is thinking, what the guidance is. We'll tune into that and give you more updates. Well, with that, it's a wrap on Halftime Report. Business Lunch up next. Stay tuned.